You're such an asshole.
Welcome to assholeconsulting.com, where I, the world's only professional asshole, will answer your questions as long as you got money. Because just like everybody else, I'm a whore. I just admit that I work for money. It's all right. We can all be whores. There's no shame in that. We're all whores. But, shh. It's okay. Be proud about your whoredom. Dear asshole, call me Chris. Last year, I sold my house to relocate for work for various reasons that you don't care. Now my dad's calling me. Why is my dad calling me now? Now he takes an interest. For various reasons that you don't care about, I'm not looking to buy another one in the next few years. My problem is I've got a pile of cash in the bank that's doing nothing. I'm already set for stock investments, and this is my buy another house fund. Started thinking treasury notes might be the right place to park this money while I figure out where I'm going to eventually land. I know absolutely nothing about bond investing, how to do it, what choices you have, etc. I'd like to pay you to do a crash course video on bond investing. So what I'm going to do, I'm going to give you the basics of bonds. Ladies, I know you're totally wet now. Just calm down. Go get your fainting couch. So we'll go over a basic course on bonds just so you guys know what it is. And I'll address your particular situations because I can't recommend any investment advice. I can only give you options. But I'd like to give you some other options that would add added flexibility to your particular situation. So that you're like, oh, it's not just invest in bonds and oh crap, the bonds didn't do what I want to do. All right, so bonds, let's be very clear. The stocks and bonds. Stocks is where you buy a piece of ownership in a company. All right, so it starts off where I'm a private company, meaning I own it all myself, or it's me and a handful of people that privately own it. But I get a big contract from Mitsubishi Motors and they want me to make their plastic dashboards. I'm like, oh, I don't have enough money to build up the factory to make Mitsubishi's plastic dashboards. Whatever will I do? And what I could say is, all right, well, I will sell shares to the public, meaning going public, that they will have a certain percent ownership. So you could buy a share of stock and that will entitle you some minor fraction of a share of the company. You could buy 1,000 of them, a million, whatever. I decide I'm going to sell off 30% ownership of the company. That will raise me the money. And in return, I will pay all the shareholders combined their proportional ownership of the profits because they're now owners of the company. So I sell 30% of shares of the ownership of the firm, however many millions of shares that might be. And now I pay out 30% of the profits to the shareholders, right? So you are an ownership in the company, right? Now, there's another way to raise the money to build the factory, to build the plastic dashboards for Mitsubishi Motor Corporation. I can borrow the money instead. I don't want to give up 30% ownership. I know that interest rates are 4%. I'm going to make 12% off of the $100 million, whatever it takes to build the factory, netting me 8%. So I don't have to sell shares. So I will borrow the money instead, pay some interest, and I will go to a bank to get a loan. Now, people get confused because they think, well, that's a loan. Right. And all a bond is a loan. That's it. Except instead of going to an individual bank for a $100 million loan, which you can do, some banks are big enough, I'm sure Goldman Sachs or even Bank of America, oh yeah, we'll do $100 million loan, or consortium of banks will get together and I'll do 20 million of the 100 million. That bank will do another, all in fifths, and we lend you 100 million, and that's easier. But if you're talking billions, you're talking, back in the hundreds of millions, but billions today, you may want to issue bonds instead. So instead of taking out a loan from a bank, what you will do is you will go to an investment bank and say, we want to borrow $2 billion. And the bank will say, okay, no one bank has $2 billion that they're going to lend to you. So because this is such a big loan you're taking out, we'll issue bonds instead and open it up to public to invest. And just like some people may want to invest in your company as a shareholder, some people are like, yeah, I could lend money to this guy if he's paying a fair percent interest. I don't have a lot of money, but I got like $10,000 laying around And so you issue bonds, which is no different than borrowing money. But instead of borrowing from an individual bank or consortium of banks, the investment bank will go out, find all the investors, either through brokerage accounts, other banks, small-time investors, rich investors, whatever, and say, okay, we're issuing bonds. They pay 7% or 6%. And it's no different than a little loan. You know how your bond says $100 bond or $1,000 bond? IBM, you give them $1,000. IBM will pay you 7%. Let's say the interest rate is 7%. On that $1,000, you make $70 a year for each bond that you own. And then usually there is a maturity date where it is decided that, and at the end of 5, 10, 15, 20 years, you will pay IBM will pay you the principal amount, give you back your principal amount. So you get your $1,000 back, 7% interest, $70 per year for 5, 10, 15 years, however long that term of that bond is. That's it. That's all it is a loan, right? So that is its financial nature. Now, when it comes to the type of bonds, it's, well, who borrows money? Everybody borrows money. So I gave you an example of IBM. That's a corporate bond. You are lending money to the IBM Corporation. And well, let's hold off on the types of how you purchase those bonds. You can have government bonds. We call them here U.S. savings bonds or U.S. treasuries. They're varying lengths of maturity, but you remember your savings bond. Okay, you went to the bank, you bought a $200 savings bond. And there they do it a little bit different. So you buy the savings bond, meaning you lend the federal government money. So on a $200 savings bond, you would buy it for, say, $100. Well, why $100? It's like, well, they're not going to pay you interest. They're just going to give you $200 at the end of 5, 10, 15, 20 years, depending on how long the bond is. And so your interest is imputed by you buying at a lower price. And so that, but it's still the same. They're paying you interest. So you could buy federal government bonds. There are school bonds, which I do believe you don't pay tax on the interest because you're helping out the schools. So sometimes tax-free municipal bonds. And then what else? There's foreign bonds like Argentina. Dude, Argentina's got a great, a lot of you guys don't know much about Argentina. Let me tell you how Argentina does it. So just like our federal government, the Argentinian federal government will issue bonds. You say, well, maybe I want to lend money to the Argentinian government. And so people have done this in the past where they've literally given Argentina hundreds of billions of dollars over the year. And Argentina just says, well, we're not paying you back. They're like, oh, okay. Let's lend Argentina more money. And the third time they don't pay you back. I'm like, you guys idiots? They're like, oh yeah, you are. You're all finance guys. Oh yeah. So there's foreign governments you can lend money, foreign corporations you can lend them money by buying their bonds. There's like a third. We got the Treasury, government. I'm sorry, corporate bonds. There's another entity. I believe David Bowie even issued bonds once. Like he borrowed money and people bought David Bowie bonds. Any entity, because you're just lending them money. It's just, how are you lending them money? Like you're actually cutting them a check, lending them money, and then you got a contract, or you got certificates that say, yep, he's going to pay you back with interest and principal someday. So that's all it is. Now, the reason you might want bonds as opposed to stocks is because bonds are less volatile. What determines the value of your investment with a company when you buy their stock is the value of the stock. And that goes up and down based on all the different economic factors, all the global factors, but primarily how profitable the firm is. And so if profits go up, in theory, the price of your stock goes up. And historically speaking, stocks have outperformed bonds, depending on the bonds you want to look at. But they are more volatile because what can happen is a company could go bankrupt, kind of like hopefully Disney will someday. And in the case of bankruptcy or there is no profits, the reason it is riskier being a shareholder, a stockholder of a company, is because in case a company gets liquidated, like, oh, they can't, they close business down. They can't pay their employees. They ran out of money or they hit bad financial times. What will happen is a company will file for bankruptcy. And then the bank, what is it, a guarantor, executor takes over. They sell the assets. And the people that get paid back first are the people who lent the company money, the creditors, the bondholders. So you get this first position if you're a bondholder. And after the bondholders are paid back whole, if there's any money left over, then the shareholders get whatever residual amount of money back when the company is liquidated. Also, as it pertains to profits, you also see it in the income statement where, okay, revenue, Disney sells some really crappy black woke vagina wheelchair quadriplegic show. And for whatever reason, actually makes money. And then you are paid last. So they pay their employees, they pay their suppliers, they pay insurance, everything to keep the company going. Then they pay the interest to the bondholders. They pay the lenders their money. And then after that, if there's any money left over, that's the profits paid for you. So in terms of being paid out, the shareholders are the last, which makes sense because you're the ones who are ultimately responsible for the firm. You got to pay everybody else before you pay yourself. That's how profit works. That's how capitalism works. It's such a horrible system. So bonds, because they're paid first, both in terms of bankruptcy and because of in terms of operations, it's less risky because you're holding less risk. And so bonds don't have as high of a rate of return, but they're also less volatile. So if you want to look at the beta of the performance of the price of stocks and bonds, you can see it there. Now, how you buy is, again, you just lending money, right? And you get paid first as a bondholder before the shareholders. And in case of bankruptcy, heaven forbid, they will liquidate the assets. Hopefully there's enough money to give you back your original investment. And only then, after all the bondholders have been satisfied, do the shareholders get money, right? So now you know why bonds are less risky than stocks. Now, how you buy bonds depends on the bond you want to buy. If you want to buy federal treasuries, federal bonds, savings bonds, the website's like Federal Treasury Direct. In the old days, you had to go to a bank. You pay some kind of commission and fee because banks weren't doing it for free. Federal government set it up. You can go ahead and buy treasury bonds, U.S. government savings bonds on the internet. I think it's U.S. Treasury Direct. Look it up. And you go ahead and you get that. You can buy all sorts of types of different federal government bonds. And the shorter term ones are called treasuries, like 3 months, 6 months. You just get a short little modicum of interest. In theory, the longer the mature, like if you get a 10-year treasury, 10-year federal savings bond, that'll have a higher rate of interest. There are inflation-adjusted bonds that you probably, for your particular situation, might be interested in because inflation is very high. And so the inflation-adjusted bonds pay a certain amount of interest plus inflation. So that's something that you might want to consider to hedge against inflation. But once again, you're lending the money to the government, and you go through Federal Treasury Direct. I think that's the name of the website. Now, if you want to buy corporate bonds, there you got to go through a brokerage. Like, I don't even know if Dean Witter's around anymore. Charles Schwab, TD Ameritrade, but I guess they're merging now. Whatever the different online brokerages are, Vanguard, Fidelity, you go through that. And depending on the website, it's not as easily traded as stocks. Stocks all have this, they're publicly traded. They have a ticker symbol. You type in the ticker symbol, you buy. Depending on how well enabled the online trading platform is, you may be able to buy, say, IBM bonds. And what you do, in theory, it depends on the online platform. You should be able to search IBM bonds, and then they will list all the different bonds that IBM has currently issued out there. Right? You find the one that, just so you know, companies do issue several, they can have 5, 6, 10 different series of bonds being issued. It's not like, they issue it once. So I'm sure if we looked up IBM's financials, you would see several issuances of bonds. One pays 5.2%, one pays 4.7, more recently maybe it pays 7.8. One matures in 5 years, one matures in 12 years, whatever. You got to figure out, okay, do I want to buy that bond for 5 to 10 years? Do I like that interest rates, et cetera, et cetera, et cetera, right? In any case, you look it up, and if you're lucky, you'll get a CUSIP number, which means and they will have the online platform to allow you to buy those particular bonds. Right now, keep in mind when you're buying bonds, you're buying from other bond holders, not necessarily the brokerage, which may have some in stock and inventory. They do that with stocks and bonds and market makers. I don't mean to bore you with the intricacies of trading, but you should be able to, in theory, go online, look up either via name or CUSIP number a bond, find out if that bond is paying a rate of interest you like, if the price is right for you, et cetera, and you should be able to place an order. Otherwise, you may have to actually talk to a human being and have them place your order. It's not as simple as stocks. All right, so that's another way you could buy corporate bonds, or the way you could buy corporate bonds. And then I'm not sure how you buy municipal bonds or overseas government or overseas bonds. No doubt you will have to go through a brokerage, but municipal bonds or school bonds, I've never invested in them, but I don't think those would be necessary. But yeah, I don't know if you want a municipal bond. I think you talk to the school or the city, find out. I don't know, but that's how you do that. Now, like any other investment, you generally don't want to invest in one stock or one bond. Why? Because that's very risky. And one of the main principles of financial planning and investing is that you should invest in a diversified portfolio so that if one stock or bond goes down, the other goes up, and you average out an overall certain percent rate of return. And this is where mutual funds, or ETFs, which is just a variant of mutual funds, have come in. And just like stocks have mutual funds, there are mutual funds composed of stocks, there are mutual funds composed of bonds, and ETFs composed of bonds. And if you want to diversify and avoid, like, well, I really want to buy IBM bonds, well, you're now putting 100% of your risk on IBM. What if someone farts at their factory and ruins all the computer boards they're making? I don't know what happens at IBM. Just let's say it's a really bad fart. Oh no, all these circuit boards are broken. Well, now your bonds go down in value because IBM's having financial troubles. So I would generally, I can't recommend anything, but if I were me, I would not be investing in any one individual bond. I'd be looking at bond funds or bond ETFs. Now, what's great about bond funds, bond ETFs, those do trade as easily as stocks, where you look up bond ETF, bond fund, and here you're going to have all the different options of bond funds in the world. Do you want Asian bond funds? Do you want tech bond funds? What kind of bonds do you want? We got skinny kids, fat kids, kids who climb on rocks. What do you want? And then you're going to have to do a little bit of research. Okay. But that is another way for you to buy bonds. And I would say probably a better and easier way, because you're immediately diversified across scores, hundreds of potentially of bonds. You limit your risk, and it's easy to trade those online anyway. All right. Now, when it comes to your individual situation where you're like, okay, I want to save some money for purchasing a house, there's no right way to answer this. The thing, and you'd like to think, okay, I got to hedge against inflation. And that's true, you do. And so you might want to be looking at things like inflation adjusted bonds. But are you hedging against overall inflation in the economy or inflation in housing? See, and that's the trick. If you hedge against inflation, yeah, okay, you're not losing purchasing power. But okay, say the CPI goes up 3% and housing overall goes up 20. Well, because you're buying housing, not a gallon of milk, you still lost 17% if you invested in the 3% inflation adjusted bond. And so here's where it almost has nothing to do with what should you invest in. It's becoming very familiar and accurate as possible, knowing as much as you can as possible where and what type of house you're going to buy. And that I would say it is as important as to what you ultimately diversify and invest your housing fund into, because it's going to govern where you do it. For example, and this is one thing I point out to the younger kids, the problem young men and women face today is they don't have the money to afford a house. That's true, but you probably do have the money to afford the land, which is why I strongly recommend everybody reconnoiter the United States or travel and figure out where you want to live, because the sooner you can find out where you want to live, the sooner you can buy land there. And once you buy the land, you have, depending on how big of a house you're going to buy, you have what's the word I'm looking for? You have locked in half the purchasing price of your house because the land would go up in value. Okay, but you already got the land. So that's one thing I'm very much for is going out when you're younger, figuring out where you want to live. And if you don't, you're not ready at that moment in time to move. But by God, by golly, here comes well endowed Molly. You really want to live in Springfield, Illinois. Well, don't wait for the price of land to go up, in 20 years, 10 years, 15 years in the future. It could go down. Go buy the land now, and your money is already invested into the land and therefore hedged against any future property inflation. Now, maybe you're not there. You don't know. Maybe you don't want to buy land. Okay, that's fine. But there's other things that you can do to hedge against housing inflation. One thing you could consider is just like there are mutual funds or ETFs for bonds, there are mutual funds or ETFs for property. Those are called real estate investment trusts, REITs. And just like there's a billion different mutual funds for bonds, there's a million different REITs or mutual funds for property. And where you might want to consider REITs to be part of your portfolio is once again, okay, you don't know where you want to live in the United States, but you do know you want to live in the United States. Okay, why don't you do some inflation adjusted bonds just to hedge against inflation? But if your goal is to maintain the purchasing power of your housing fund, it would not be the worst idea to consider and evaluate. I'm not saying to consider and evaluate having a real estate investment trust be part of that portfolio. And the reason why is, again, you don't know where you're going to live in the United States. But if you throw your money into a real estate investment trust, that should track housing prices on average, right? Maybe you inevitably buy in Tennessee, and Tennessee prices went up 20%. Okay, your real estate investment trust that you invested on the nationwide U.S. real estate investment trust index, maybe that went up 15%. All right, but that did go up 15%, so you maintain 15% of that 20% increase. Whereas if you just inflation adjusted bond maybe only went up 7 or something like that. It is not a guarantee that the real estate investment trust that you invest in will exactly match the increase in price of the property or the house you would inevitably want to build. But there should be a correlation, a positive one, that, okay, you threw money into a real estate investment trust. Over 5 years' time, the piece of property you wanted to buy, you inevitably figure out, I want to buy this property. That has gone up 27% in 5 years. Well, then you look at your real estate investment trust, that went up 23%. Okay, not bad. You hedged against inflation there pretty well. You're 4% short. That's better than just letting it sit in cash. Or the real estate investment trust went up 32%. All right, through the various properties that trust owned, it went up more than your target property. That'd be the ideal situation. But then there's also the downside, which is not necessarily a downside. Let's say you invest in a real estate investment trust and it goes down 10%. Well, if the overall real estate investment trust went down 10%, chances are the property you wanted to buy also went down, maybe by 12, maybe by 8, but it also went down. And while, yes, you did lose money, you hadn't lost money yet because you didn't sell it, but the value of your investment, your housing fund, went down. You're not concerned about the value of your investment fund going up or down. You're worried about it maintaining its purchasing power. And so if you had a real estate investment trust that went down, chances are the property is cheaper. So you maintain your purchasing power, not the nominal balance of your investment, if you know what I'm saying there. Ideally, let's say you knew you wanted to invest. I got to go to Tennessee. Oh my God, I got to go to Tennessee. There very well might be a real estate investment trust that has a Tennessee, we only invest in Tennessee properties. So it's going to be more localized and probably track your future property you'd like to buy even more accurately. But that's another thing for you to consider. Although I would argue, if you know you want to live in Tennessee, I'd immediately just go to Tennessee, drive around, spend a month down there if you have to, and figure out what town you want to live in, and just go buy the damn property at that point in time. And then you don't have to worry about, Did the real estate investment trust trail by 3% or did it outperform by 4? You don't have to worry about that. Let me go here. So I'm not saying bonds are bad, and they're the part of every well-balanced portfolio. You should have some bonds just for your retirement portfolio as well. And bonds can, they'll provide a modicum of interest and hedge a little bit against inflation, especially inflation bonds. But something you evaluate further would be, some real estate investment trust. And it also depends on how far out you are. Like if you're going to invest within the year, I don't know, you got to pay commission on these trades. Is it worth it setting up all the time and effort? Just hold off. And okay, you lost 3, 5, 6, 7%. Fine. All right. But if it's like, oh, it's going to be a while, 10 years. Yeah, you're going to have to invest in some kind of portfolio and diversify. What the underlying investments are and what allocation and percentages, I don't know, because I can't advise you on that. That's where you'd hire a financial professional. The options, make sure. Pile of cash in the bank doing nothing. I'm already set for stock, and this is my buy another house fund. Start thinking treasury notes. Well, I figure out where I'm eventually land. Absolutely nothing about bond investing, how to do it, what choices you have. Okay, so we went through that. Like to do videos. Yeah, so there's your bond investing. Yep. So I think, a little bit. It's not the worst thing. But I would really focus more on figuring out where you want to live. I got a book out there called Reconnaissance Man. It tells you how to reconnoiter the United States. That's what I would be doing, because then you at least know, okay, keep an eye on these several markets and their housing and pay attention to that. It'll also put a fire under your ass to make sure you go out and do it. That I think, what kind of house do you want? Do you want that? And the land, the sooner you could figure out, I want to live here, then you can get the land. And then what you put on the land is kind of almost moot. Build your own bachelor hut. You want a trailer temporarily. You could wait for a housing crisis to hit and no one's buying houses anymore. And then you got some desperate contractor that would actually work, maybe show up on time and not be drunk, pull his dick out of his sister and actually do his job, but yeah, the land, aim for the land first. Well, first figure out where you want to live. Second, aim for the land. Or if there's already a house existing, then you already know there's the house. And make moves so you can move there sooner than later. That's what I'd say. All right. So link below is Bachelor Pad Economics. If you guys are interested in financial planning, that's the Financial Advice Bible for Men. 500 pages for all major, minor, and mediocre financial decisions you will have to make as a man. And also link below for those of you interested in investing is Achieving Financial Excellence, which is what I consider the step one or square one. If you finally want to get serious about retirement planning and saving up money and getting your finances together, there you go. That's the one I'd recommend you take. And yes, I charge money for it because I am greedy. Willie Mendoza, $5. I got a job as a teacher in Fresno for $66K. So that's barely above the poverty line, right? In California. 22 and tired of living with parents and know you hate teachers. Is there an issue if I become a teacher? No, look, Willie, there's good bankers. They're not common, but there are good bankers. There are good politicians. There are good, trying to think what else is there are good journalists. Generally speaking, though, the majority of politicians, journalists, teachers, and bankers are the scum of the earth. It's up to you whether you're going to be a good teacher or not. I mean, I had good teachers. Out of 89, I added up 89, 3 were good. The rest could go swim to Japan with cinder blocks around their waists in Minecraft. So if you teach the kids right, you don't teach them oh my God, your gender and the color of your skin are the most important things. And all hail Karl Marx and socialism in your, if you don't lie to them, that's good. You teach them what you're supposed to teach them, their ABCs or arithmetic, whatever. That's fine. You could be a good teacher. There's nothing wrong. Absolutely. You could be just, I'd be curious, Willie, what it's like being a teacher nowadays. Because they used to teach, I was a substitute teacher, and then I taught economics and statistics at college. And Man, the kids were crap back then. I'd be very curious what a public school, California school is like. Like, is it like the movie Salo where they're eating their own feces and it's just pure anarchy and chaos? I would love to see. I'd love to see. Net worth rising $5 crappy. I'll give you 1,000. I'll give $1,000 to Thor and Missy if I could see you on Fresh and Fit and school that Destiny boy about the merits of college. I know of Destiny. I don't know Destiny. And yeah, I don't control whether Destiny is going to be on Fresh and Fit. I am going to be on Fresh and Fit this Monday, though. We're going to have Money Mondays with me and Myron and Walter. And if it happens, if Destiny happens to be there and we also happen to talk about college, yeah, I'll do it. It's not like I'd school them. I just, well, here are the facts. You're wrong. And you can. Should I keep banging my head with the hammer? No, you shouldn't. Well, I'm going to keep doing it for whatever. All right, have fun. I don't care. I don't care if people go $100,000 into debt for a worthless degree. But yeah, I have no problem having a conversation with Destiny. Drew, $2. I just purchased $500 worth of I-bonds today. Oh, cool. All right. Yeah, did you go through the Federal Direct thing? I presume you did. Drew, $5. I-bonds are at 6.89, but we'll reset the 3.89 because they reset every 6 months. There is no rhyme or reason to why the Treasury Direct does this. I think it's because they can't afford 7% interest. Oh. Net worth rising $5. I'm sorry, Cappy, autocorrect. I thought you were just poking fun at me. I will do anything to see you destroy Destiny face to face about college. His position is polar opposite to yours. Here's the thing. I don't destroy people. In a very Dennis Prager's way, he was he is very intelligent. He says, I prefer clarity to agreement. And all I'd want to know is, okay, that's your position. All right. Fine. People should, if he's truly the polar opposite, then he would say every degree is a good degree. And we should all get doctorates. That would be the true polar opposite. I don't believe anyone would be that irrational. But I don't destroy. I just simply, all right, so you think this, and you would agree with this, and that's just your stance and your position, and there wouldn't even be any animosity. And I'd say, well, here's my position. I think you're wrong because of that. And this would be the consequences of people following your advice. And he could say the same thing. Well, if everyone did with you, we'd all be tradesmen. We can't all be engineers. I've had that one a million times before. We can't all be engineers. And AI is just going to eliminate all the jobs. I'm going to sit here and suck on my thumb and jerk off to Andrew Yang's UBI proposal. Yeah, I don't know if we would destroy as much as it would be a conversation. And I would make the positions very clear so that the audience would benefit from that and say, oh, well, that cat over there said that. I don't want to go to school for 6 years to be in debt. But yeah, I don't care. He can say whatever you want. Drew, $5. It's important to be diversified. I've got a Vanguard brokerage accounts, I-bonds, Roth IRA, and I'm buying years back in my pension, as you suggested. Okay, good. There you go, man. Ray John, 220 Canadians. Bond, James Bond. Oh, Vlad Elkham's in the house. I'm not going to ask people to have different people on the show so I can debate them. If you want, go email Fresh and Fit and say, I'm going to be there Monday. Make a super chat. Say, I want Cappy to debate Destiny on the merits of education, higher education. Is that it? That's it. There we go. All right. Nothing to steal from Steven Destiny, but I'm not fearing him. Is there ever, does it always have to be blood sports? Can it just be a reasoned discussion? I'm too old to get pissed off anymore. Okay, people can follow your advice. All right. He's literally man-child compared to you. Don't see why chat is so itching for a fight. What's the deal? All right, let me look up Stephen Bonell. Stephen Bonell. Streamer. He's got a Wikipedia entry. Oh, his show is called Destiny. The second. Oh, comes from wealth. He's a millennial, American internet personality, political commentator, first people to stream video games online. He probably has millions of subscribers. Early life, born in Nebraska, Cuban American, white American father, raised conservative Catholic home, attended Creighton, private Jesuit high school for, oh yeah, he came from money. Preteen, mother, home collapse, family was, okay, then he didn't come from money. All right, that's an interesting background. So he grew up bounced around a little bit. Parents moving in to take care of an aging relative, for which he lived with his grandmother until he was 18. All right, so this guy didn't have it exactly, ball across the plate. He studied music while working night shifts at a restaurant. Manager had see, all right, this guy works. He supported himself. Ultimately unable to juggle both his education and full-time work, dropped out. Soon he was fired from the restaurant position, found work as a carpet cleaner. You see, he should have become a security guard. Then he could have focused on his studies. In 2011, live stream Twitch. Okay, so he's got 650,000. So he made it. He got lucky and made it as a Twitch streamer. Political debates, coverage of right-wing YouTube commentaries, subsequent academic coverage of right-wing music, really effective opposition to it, particularly owing to his provocative, combative debate style, which appeals to right-wing gaming. Appeals to a right-wing. So he's on the right side. He's a right-wing leaning guy. I'm not rolling around with pigs in mud. I'm not going to yell. I'm not going to scream. It's just going to be okay. All right. Not to persuade opponents, but to persuade the audience. Express that airing his opinions feels like screaming into the void. He estimates received hundreds of emails, alt-right crediting him for conversion to left-wing politics. Crediting him for their conversion to left-wing politics. I don't know. In 2019, Bono began debating in favor of capitalism against. Okay. And here's another thing. Do that much. I know he's young, 20. Video games. The evil capitalist pig. Hey, I'm Russell Brand. I don't know if we'd really have a very saucy debate. I'm kind of curious what his opinion is on education, because he's not like some rank. He's not an NPC. I'm sure he has his own formulated opinions. So yeah, we could do that. All right. All right, that's it. I'll see you guys later. Toodles.